Stop why the 1928 gold erasure is hiding in your bank account. Look, I'm gonna tell you something. Your balance isn't yours. A rule baked in during the late 1920s quietly rewired who gets paid first and erased your place in line. Trust me, you're not ready. The line item still sits in your account math, hiding in holds, spreads, and delays. Here's what actually happens. In 1928, France locked the franc to gold at an undervalued rate and sterilized the inflow. That flipped settlement priority up the stack. I'll show you the mechanism, the enforcement network, and the drain you can measure on your own statements. Once you see it, there's no going back. Are you sitting down? Once you see this, there's no going back. We're building on 3 pillars: mechanism, network, drain. First, the mechanism, what actually changed in the 1920s. People hear gold and think confiscation. That's not it. The gold erasure wasn't chains on coins, it was surgery on the unit of account. Most people think the gold standard is metal for notes on demand, but the interwar fix turned it into a hierarchy of claims. Redemption didn't vanish, priority did a cartwheel. Convertibility at the top stayed sacred, below it money got elastic and your place in line slipped. Context matters. The 1920s were a debt hangover, war debts, German reparations, fragile budgets. The Genoa 1922 conference floated the gold exchange standard, using pounds and dollars as reserve layers to save on gold. But here's where it gets interesting. By 1928, practice had hard-coded settlement priority. France's return to gold at an undervalued franc pulled metal in. The Bank of France sterilized the inflow. Central banks insulated gold and pushed elasticity downward. That's the switch. Not no gold, but gold for the few, elasticity for the many. Now what most people mix up. Genoa 1922 versus late 1920s accords and norms. Genoa legitimated layered reserves. The later move, real policy, by 1928 made central bank claims senior to private redemption pressure. In plain English, when stress hits, the top tier clears first, your claim waits. The hidden lever is settlement priority versus redemption right. You can redeem in theory. In practice, your settlement can be delayed, netted, or repriced while the top tier settles instantly. That's the erasure. Second pillar, the network. Who enforces this? Behind the scenes, the club formed to keep that hierarchy tight. Central banks at the apex with direct access to reserves and later swap lines. Correspondent banks with nostro and vostro balances. Clearinghouses that decide what posts and when. From telegraph codes to today's chips, Target 2 and CLS, they run the rails. The rules live in culture and code, lender of last resort protections, resolution regimes, and priority in insolvency. The muscle memory says, protect the core, pass the cost down. Third pillar, the drain, how it hits you. You feel it as float, fees, FX spreads, processing windows, and the quiet interest gap between what your bank earns on reserves and what you get on savings. It's the weekend FX buffer on your card, the 2-day ACH that somehow takes 3, the escrow balance that sits for months, the posted but not available funds. That's the daily bleed. Unit drift at the top becomes cash friction at the bottom. Wait until you see the clause that survived. The wording varies by country and bank, but the logic is the same. Payment finality sits with the institution, and your funds availability right is conditional. Add the right of set off, and your deposit is a loan to the bank, junior to other obligations when stress rises. Sounds abstract, until your transfer hangs for compliance review. Your wire lands after the rate moved, or your refund posts after statement close so you still pay interest. Now stakes, this isn't a history hobby. It compounds against you. Every day your money is in transit, someone else earns. Every time your card converts at a tourist rate, the spread taxes you. Every mortgage month front loads interest by design. The hierarchy didn't die, it learned software. And yes, the number that flips everything is coming when we decode the settlement rails. A simple priority index you can track with public rates, central bank rewards versus your APY. The gap. That's your erosion. Let's pull the wiring diagram. The 1920s pipeline. From gold exchange to settlement hierarchy. Okay, so here's the thing. The gold standard most people picture, walk into a bank, hand over notes, walk out with coins, was already fading by the early 1920s. Genoa in 1922 blessed a workaround called the gold exchange standard. Instead of every country hoarding metal, they could hold reserves in key currencies, mainly sterling and dollars, pegged to gold. On paper, this saved gold. In practice, it stacked IOUs on top of IOUs with a thin metal layer only the top tier touched. Most people think that kept discipline. It did the opposite. It built a ladder. Now this is important because it set hierarchy in motion. At the top sat central banks with direct access to gold and each other's balances. Below them, commercial banks with claims on those central banks or their correspondents. And below that, you and me holding deposits at commercial banks. Convertibility didn't disappear, it migrated upward. Gold became an institutional privilege, not a public reflex. Once you grasp that, the rest of the decade clicks. Behind the scenes, planners were sketching coordination years before anyone cut the ribbon in Basel. The Bank for International Settlements would open in 1930, but the idea, credit clearing across borders, netting flows so metal rarely moved, was quietly embedded after 1922 and hardened as the 1920s wore on. Telegraph codes turned into rulebooks. Finality for insiders beat redemption for everyone else. Gold didn't leave, it went behind glass. Everything changes in 1928. France's stabilization, de facto around 122.5 francs per pound, then de jure in June 1928, returned the franc to gold at a level widely viewed as undervalued. Capital saw a haven. Gold flowed into Paris like a tide. Most people think that should have flooded credit at home, gold in, money out. But the Bank of France sterilized much of the inflow. Balance sheets absorbed metal without letting domestic money balloon. Convertibility at the top stayed on. Below, money tightened where it suited policy. That's the switch, not no gold, but gold for the few, elasticity for the many. So what does elasticity really mean? Timing and terms. The unit of account, the number on your ledger, could drift from the old metal constraint because the discipline was enforced at the apex, not the branch. Central banks settled among themselves in gold or key currency on their timetable. Commercial banks netted and batched. Your claim could be delayed, repriced, or netted while the top tier cleared instantly. The lever wasn't convertibility, it was settlement priority. That's the quiet erasure. Let me show you how it landed on the ground. Micro story. A 1929 importer in Antwerp buys machine parts from Birmingham. He pays in sterling via his Belgian bank, routed through a London correspondent. First hit. The invoice already bakes in tighter credit as the gold exchange stack wobbles. Second hit. The bank lifts a fee and a spread on the telegraph transfer. If there's a hiccup, the payment sits, awaiting confirmation at the correspondent while his own buyer calls daily. He pays twice, sticker and spread, plus any delay cost. Sound familiar? That's your wire pending until tomorrow's window. You probably think the hierarchy died with the Great Depression. It didn't. The BIS in 1930 formalized the pipeline, coordinate central banks, keep top-tier settlement liquid, socialize strain by pushing flexibility downward. Through the early 1930s, support credits tried to steady Austria and Germany. Even when those efforts failed, the lesson stuck: protect the rails first. The interwar mindset hardened into muscle memory. Now this is important because those choices became software. High-value systems like Fedwire and Target 2 guarantee finality for members with central bank accounts. Chips batches exposure so the core settles cheap and fast. CLS wraps foreign exchange so big players avoid Herstat risk by settling both legs at once. Retail, you live on conditional availability. Your deposit can be posted but not available. Your card can face a weekend buffer because FX rails sleep. Same ladder, new code. Here's the reveal that ties it back to 1928. France's sterilization wasn't a footnote, it was a proof. If a major central bank can hoard gold and refuse to inflate in step, the rules of the game break. Once the rules break at the top, everyone else adapts below, netting, batching, widening spreads, lengthening holds. That habit became doctrine. Settle insiders first, ration certainty to the public through time and price. The BIS gave that doctrine a meeting room and a calendar. Micro story: last week a viewer paid a supplier in Mexico City. USD left his bank fast, hit a New York correspondent, then a Mexico City bank. Received stamp before lunch. MXN conversion, next day's window. Overnight USD MXN moved. The bank executed at their morning rate, skimmed the spread, charged a fee. He ate the drift. That's correspondent float plus FX market structure, legal, predictable, and straight out of the hierarchy. Once you understand the pipeline, Genoa's layered reserves, France's 1928 sterilized inflows, BIS coordination in 193, you can read your statements differently. Pending is policy. Spread is rent for certainty you don't get. Hold is the retail face of wholesale finality. The metal didn't vanish, your position in line did. The enforcers, central banks, correspondents, and the clearing cartel. Behind the wiring, there's a crew that keeps itself breathing first. Look, I'm gonna tell you something. The hierarchy isn't a law of nature. It's managed. And once you see who manages it, your pending screens start making sense. Start at the apex, central banks. They're the only players who move reserves on real-time gross settlement rails with legal finality on call. In stress, they open swap lines, prearranged pipes to swap dollars for euros, yen, pounds, so foreign central banks can fund member banks without touching retail. That's not a conspiracy, it's the job. But here's where it gets interesting. When liquidity's scarce, it rushes through those pipes first. Big banks with access exhale, core spreads narrow, and everyone else inhales the leftovers, later at a price. Drop one rung to the backbone, correspondent banking. Before instant anything, banks kept nostro and vostro balances, my money at your bank, yours at mine. That web still runs under Swift messages. Every cross-border wire you send hops those accounts. Each hop triggers a reconciliation window, a sanction screen, a daylight overdraft decision, and a micro spread for the service. The float sits in someone's nostro while your app says processing. Who earns on that overnight? Not you. Payment rails turned muscle into code. High-value transfers clear on chips in the United States, Target 2 in the Euro area. These aren't retail toys, they're industrial nets. Members profund, exposures net, and central bank money finalizes in minutes. Upstream finality is near instant because insiders post collateral and accept rules. Downstream, your bank updates your ledger when treasury and compliance are comfortable. For foreign exchange, CLS wraps both legs at once to kill, Herstat risk. If you're inside CLS, you dodge settlement gaps. If you're not, you carry weekend and holiday buffers that widen the card rate at your hotel desk. Who sets the tone? A small, coordinated club, cartel in the literal sense of a closed agreement, not the Hollywood version. The Bank for International Settlements in Basel hosts governors, market committees, and risk councils. Out of that comes playbooks, liquidity backstops, supervisory letters, and the Basel Capital Framework. Basel puts sovereign bonds and central bank reserves on the top shelf with low risk weights. Small business and unsecured consumer credit sit heavy. That algebra sets your pricing map. Cheaper at the core, pricier at the edge. Legal shields lock the order. Lender of last resort powers let central banks flood sound collateral with cash, but the hose connects to member banks. Resolution regimes say keep critical functions running, which means wholesale settlement and clearinghouses get priority. Deposit insurance calms the line, but funds availability rules and right of set-off give your bank room to breathe before you do. In a crunch, rails run, retail waits. You probably think competition kills this. Sometimes it helps, but watch spreads when volatility spikes. Market makers protect top-tier counterparties with tight quotes, then pass uncertainty down as liquidity premiums. Your weekend FX add-on? It's the retail face of value-at-risk models that hate closed markets. Networks can't hedge when spot is shut, so they price the unknown into your Saturday dinner. That buffer is policy boiled down to a checkout line. Micro story, a small importer pays a supplier in Sao Paulo. His bank promises same-day USD out, BRL and tomorrow. The wire leaves, hits New York, then a Brazilian correspondent. Received stamps before lunch, then sits awaiting conversion until the BRL window. Overnight, USD BRL moves 0.6%. The bank executes at its morning rate, pockets a spread, and charges a wire fee. He eats the drift, perfectly legal, perfectly predictable. Message standards carry the pecking order. Old Swift MTs and now ISO 20022 include fields for priority, cutoffs, and charge codes. OUR SHA BEN plus compliance flags. Miss a chip's cutoff by 5 minutes. Tomorrow, miss CLS's window, weekend buffer. ISO 20022 adds richer remittance data, which can reduce holds if you feed it well or trigger holds if you trip a rule. The code doesn't hate you. It enforces parameters. Everything changes when you follow incentives. Central banks prize system stability. That means pipes before perfect fairness. Correspondents want return on balances. That means maximizing non-interest revenue, spreads, fees, float. Clearinghouses want certainty. That means profunding, netting, and daylight overdraft limits for insiders. No one wakes up to drain you. They wake up to defend the stack. Your drain is the byproduct. Behind the scenes, terms translate architecture into your Tuesday. Payment finality means once the system settles for participants, it's done for them. Your posted balance is a mirror that can lag. Availability is a risk policy, not a right. Right of set-off lets your bank net your deposit against debts you owe them, even if that deposit just landed. That's the hierarchy printed in your account agreement. Now brace yourself because the plot thickens at quarter end and on holidays. Treasury desks manage liquidity ratios and window dress balance sheets. You'll see maintenance windows, longer than usual holds, and tighter limits on instant rails. Plan a big move on a Friday before a long weekend. You just volunteered to fund someone's nostro. So who are the enforcers? Central banks at the top with swap lines and standing facilities. Correspondents in the middle skimming time value through cutoffs and spreads. Clearing utilities, CHIPS, Target 2, CLS, guaranteeing finality for the club. And the legal scaffolding, Basel resolution funds availability set off, that keeps the rails pristine while you wait at the platform. Once you see that lineup, the delays in your life stop feeling random. They're the retail echo of wholesale certainty. And now that you've met the crew, we can open the next door, where they encoded these priorities into accounting rules and core systems so the drain runs on autopilot. How it got into code, accounting standards, and core banking. What I'm about to show you looks boring on paper, but it's the switch that makes the hierarchy automatic. Double entry met batch processing, and the calendar became a profit engine. End-of-day cutoffs decide what counts for interest, liquidity ratios, and risk. If your payroll lands after the internal posting window, the availability clock starts tomorrow. That single night afloat, it accrues to them, not you. Now this is important because accounting rules reward that timing. Under GAAP and IFRS, banks slice cash into buckets. Cash and due from banks, central bank reserves, securities, and customer deposits. Interest on reserves accrues daily and posts with precision. Your savings APY posts monthly or even quarterly. The spread is built in. When funds sit in transit, they're an interbank receivable that reduces funding need or earns yield, while your app says pending. The chart of accounts bakes hierarchy into language. Settlement assets and clearing balances are treated as near cash for liquidity tests. Customer liabilities can be lagged in availability under policy. Treasury sweeps intraday surpluses from retail ledgers into reserve accounts or overnight reverse repos before midnight close. You see processing. They see deployable balances. Message standards turn policy into code. Old Swift MTs and now ISO 20022 carry fields for priority, cutoffs, and charge type, OUR/SHA BEN. They also carry compliance flags, purpose codes, remittance data. Hit a normal priority and miss the rail window by 4 minutes. Tomorrow's settlement. Choose urgent. Higher fee, earlier profunding, faster finality, upstairs. ISO 20022's richer data should reduce false positives, but it also empowers triage. Sanction names, risky geographies, velocity spikes. More detail means faster green lights for the right profile, and longer amber for you if you trip a rule. Basel Capital nudges the balance sheet toward the apex. Sovereign bonds and reserves get low risk weights. Small business loans and unsecured consumer credit sit heavy. That math incentivizes parking more assets at the top and squeezing margin from the edge fees, spreads, and time. Liquidity coverage ratio and net stable funding ratio lock in buffers. To look strong on those tests, banks prefer inflows early and outflows late. Your posting time becomes their metric management. On securities, IFRS lets held to maturity sit at amortized cost. Market swings don't touch earnings unless they sell. Available for sale flows through other comprehensive income, not straight into P&L off-balance sheet items. Undrawn lines, some derivatives, live in footnotes with conversion factors. When stress hits, those hidden claims tighten internal liquidity. Treasury reacts by widening spreads, throttling instant rails, or extending holds. Everything you feel as longer than usual. Core banking systems still run on batches, even when the app feels live. There's real-time posting at the front, but nightly jobs reconcile, net, and book interest. Anti-money laundering screens, sanctions filters, fraud analytics, each is a checkpoint with a timer. Provisional credits can reverse if an item returns unpaid. That's why a mobile deposited check clears, then vanishes 2 days later. Wholesale finality settled. Retail availability stayed conditional until the batch said so. Cards in code delay by design. Authorization at the counter places a hold, clearing posts later. Interchange pays issuers, chargeback rights give them optionality. Refunds often ride the slow lane back because they're screened like new credits. Weekend or holiday, FX markets shut, CLS closed, hedges imperfect. Issuers add a buffer. The code doesn't care that you checked out Friday night. It cares that the hedge can't run until Monday morning. Micro story, a Friday deposit hits at 4:06 p.m., 6 minutes past the internal cutoff. The app shows posted. Treasury sweeps that balance into reserves overnight, books daily interest. Your availability date stamps Monday. Same dollars, 2 clocks. The bank's clock pays. Yours waits. Legal text seals it. Funds availability policies say may place holds, case by case. Longer delays in certain cases. Force majeure covers outages and market closures. Right-up set-off lets the bank net your deposit against debts you owe them immediately without notice. Netting and close-out agreements upstream guarantee that member exposures settle clean. Downstream, your ledger mirrors that certainty when the rules allow. Everything changes when you learn to root inside this code. Practical moves, fast wins. Land deposits before internal cutoffs. Ask your branch for the real times. Feed ISO 20022 fields when invoicing. Purpose, invoice IDs, tax data, fewer false holds. Use instant rails where your bank has posted collateral. RTP, faster payments, instant SCPA, for finality now, not tomorrow. Split large transfers below manual review thresholds. 4 clean RTP pushes often beat 1 OC that sleeps all weekend. Park idle cash in an insured sweep or T-bill ladder so you're pending. Buffer earns top-tier yield while it waits. Once you see how GAAP, IFRS, Basel, Swift, ISO, and batch cores rhyme, pending stops feeling like chaos. It's a schedule, and the schedule serves settlement priority first. The Arctic detour that isn't. Resource collateral and shipping lanes. This is going to sound sideways, but the Arctic isn't a map, it's a balance sheet. Shorter routes, new fields, tighter choke points, those turn into collateral. Collateral turns into cheaper funding. Cheaper funding buys priority on the same rails we just decoded. Start with the routes. As seasonal sea ice thins in the 2010s and 2020s, the northern sea route can shave up to 2 weeks off an Asia-Europe trip. Days saved aren't just fuel, they're time value of cargo. Underwriters quote different premia, traders promise tighter delivery windows, and banks adjust working capital math. Faster turns mean lower inventory days outstanding, which lowers borrowing needs. Lower borrowing needs compress spreads for the players close to the core. The knock-on is simple. When their cost of capital drops, they bid for capacity on settlement rails with cash posted and fees prepaid. Finality climbs the queue. Now the resources. The Arctic holds hydrocarbons, metals like nickel, and access to rare earth supply chains. Those aren't headlines, they're covenants. Reserve reports support loans, liftable barrels at a known break-even support term sheets. When a state can point to multi-decade cash flows in oil and gas, its sovereign curve tightens. Basel weights keep sovereign paper light. Banks park more at the top, fund cheaper, and pass discipline down the stack as time and price. Same hierarchy, colder scenery. Here S where it links straight back to you. Trade finance runs on haircuts. A cargo of crude in transit can be repoed. A warehouse receipt can be pledged. A charter party can be collateral. Control of lanes and fields reduces transit and delivery risk, which tightens haircuts. Tighter haircuts, free balance sheet for the banks inside the club. Free balance sheet means fatter daylight overdraft cushions, easier pre-funding, and faster wholesale finality. Downstream, your wire still awaits review. That split is the gold for the few. Elasticity for the many, logic wearing a parka. Sanctions and fragmentation make this vivid. In 2022, reserves were frozen and energy flows rerouted. Central banks took notes. Gold purchases ticked up because securities can be seized. Metal at home can't be blocked as easily. Meanwhile, cargoes found parallel pipes, alternative insurers, new charter networks, non-dollar rails. That birthed corridor-specific risk. Inside favored corridors, spreads stayed tight. Outside, haircuts widened, settlement windows shrank, and compliance screens stacked. Retail saw it as weekend FX buffers, growing and longer than usual holds, especially on cross-border payouts touching flagged routes. You probably think, shipping lanes are oceans away. How does that touch my card? Watch the buffers. When insurers hike deductibles on ice-class routes, trade finance costs rise. Importers hedge harder, merchants see basis risk, and processors widen FX cushions on weekend authorizations. Your Saturday hotel hold abroad books at a safer internal rate because CLS is closed and the corridor's volatility reads hot. Monday, the adjustment posts. You eat the drift. Micro story. A freight forwarder in Rotterdam told me their revolving credit margin jumped 40 basis points mid-quarter. New exposure to Arctic LNG charters, higher insurance deductibles, tighter roll windows. His banker needed more collateral reporting, earlier cutoffs on draws, and warned of temporary end-of-month throttles on same-day payouts. He stretched payables by 3 days to cope. Suppliers faced holds. Their employees saw payroll post Monday, not Friday. Energy route risk became 2 days of pending in 3 households. Behind the scenes, quants wire routes into limit frameworks. Voyage times, bunker spreads, ice-class premia, sanction lists, reinsurance capacity, those feed expected loss and value at risk. Desks that bridge price gaps need bigger credit umbrellas. Bigger umbrellas require more prefunding on wholesale rails. When funding costs lift, treasuries defend liquidity ratios by slowing discretionary retail outflows. Stricter instant trail limits, earlier cutoffs, longer case-by-case holds. None of that says Arctic in your app. It says processing. Now this is important because it closes the loop from geopolitics to your timestamp. Collateral quality at the top sets haircut discipline. Haircuts set how much prefunding insiders need for finality. When insiders need more, they buy certainty with cash and take time from you. It's the 1928 switch again. Settlement certainty up top, schedule management below. And here's the twist that changes how you plan trips and transfers. Corridor tags matter. Payments touching high-risk lanes draw extra screening even when you're clean, so you route around it. For large cross-border transfers, ask providers for corridor disclosure and a guaranteed spread window. If they won't name it, assume the widest pad. Avoid big weekend authorizations abroad. Prepay midweek at the desk in local currency on a true zero FX card. If your business invoices along flagged routes, enrich your ISO 20022 data, purpose codes, invoice IDs, tax fields, so the green light is automated, not manual. Brace yourself. When central banks add gold, it's not nostalgia. It's bargaining power for swap lines and emergency support. Stronger bargaining tightens top-tier spreads, which often widens bottom-tier buffers. So yes, the Arctic looks like a detour. It's not. It's a haircut dial, and when that dial turns, your available flips slower while their finality hits now. The science lock, energy constraints that keep the system afloat. This is going to sound crazy, but money follows watts. When usable energy is cheap and steady, spreads compress and the rails glide. When it's tight or jumpy, buffers grow, holds lengthen, and the hierarchy digs in. Once you see that, the pricing on your account reads like a power grid. Start with one simple lens: energy return on investment, EROI. It's how much energy you get back for 1 unit spent to pull, refine, and deliver it. In the mid-20th century, conventional oil fields had sky-high EROIs, which meant slack everywhere, cheap freight, predictable schedules, quiet volatility. As EROI slides with deep water, tight shale, or complex LNG chains, the system's cushion thins. Less cushion, more sensitivity to shocks. Finance prices that in: wider bid-ask, fatter weekend FX pads, extra days on funds availability. Same precaution expressed in money instead of megajoules. Now you might be thinking, isn't technology supposed to smooth this out? It helps, but physics still sets the floor. Grids pay for capacity, inertia, and storage. Capacity is peak push, inertia is the stabilizing mass, storage is the buffer. All three have dollar tags. Retire too much spinning mass too fast and frequency risk rises. Balancing markets get busy, margin calls jump. Traders bridge those gaps with credit. Their desks lean on the same banks that run your ACH. When balancing costs spike, treasuries defend liquidity, tighten instant rail limits, widen internal spreads, and stretch case-by-case holds. You won't see frequency deviation on your statement. You'll see processing window extended. Oil still underwrites modern settlement credibility through the dollar-cleared forward curve. When storms, geopolitics, or refinery outages hit, margin requirements jump across futures, swaps, and physical hedges. Dealers post more collateral, repo haircuts widen, daylight overdraft appetite shrinks. The top tier buys certainty with cash. Downstream, your bank slows discretionary releases. Pending lingers while crude waits at anchor. What about nuclear and renewables? Financing is the tell. Nuclear is capex heavy with long build times, high rates amplify risk, so utilities pull more credit and covenants tighten. Intermittent renewables shift cost into balancing, ramping gas, batteries, demand response. When dusk kills solar and wind stalls, 15-minute prices spike. Market makers need bigger VAR umbrellas, which means bigger credit lines. Where do they get that? Same lenders, same rails. If funding costs rise, something gives. Stricter instant limits, earlier cutoffs, thinner grace. Micro story: a regional utility hedged winter gas with options. Volatility surged. Margin calls hit daily by 10 a.m. Treasury swept cash from payables to meet calls, told ops to move vendor runs to net 45 temporarily. Vendors leaned on factoring. Their advances cost 150 basis points more that week. Payroll for one contractor landed after cutoff on Friday. Employees saw funds Monday. That's a cold snap turning into 2 days of pending on 3 paychecks. Now this is important because it links physics to your rate. When EROI declines, more capital is needed to deliver the same usable energy. More capital demands better collateral. Better collateral demands tighter haircuts and stricter settlement at the top. Strict at the top means conditional below. The 1928 move, settlement certainty for insiders, schedule management for everyone else, gets fresh fuel every time energy gets choppy. You probably think instant rails break this. They help where participants pre-post liquidity and accept finality. RTP, faster payments, instant SEPA, those fly because members put skin in the game. But when funding costs jump, some banks lower limits, push large items to slower rails, or invoke maintenance windows. The app still feels fast. The pipe breathes shallow. FX buffers are the retail face of wholesale uncertainty. Card networks hedge aggregate flows, but not perfectly over closed markets. If an OPEC headline or pipeline outage drops on a Friday, issuers pad weekend authorizations. You tap, the system books a safer internal rate. Monday, it trues up. If the move went against you, you paid the cushion. Here's the loop, clean and sharp. Energy volatility raises margin and collateral needs. That tightens top-tier spreads but soaks up intraday cash. With less slack, banks ration certainty. Insiders get finality now, retail gets time. Every risk model, cards, mortgages, payout processors, sneaks in an energy term under macro. That's why a refinery fire 2 states away becomes longer than usual holds on cross-border payouts and stricter same-day ACH cutoffs. So what do you do with this? 3 quick plays. 1. Schedule large transfers Tuesday to Thursday mornings, far from holidays and quarter ends when treasuries breathe easier. 2. Avoid big weekend FX authorizations. Prepay midweek in local currency on a true zero FX card. 3. Keep a 1-week pending buffer in a high-yield sweep. When buffers expand, you won't swipe penalty APR to bridge a grid hiccup. Once you accept that money rides on megawatts, you stop arguing with the teller. You start reading the load curve, and you time your life to the cutoffs. Because when watts get weird, rails get strict, and your best move is to move before they do. The drain you can measure, fees, spreads, and float. Enough big picture. Let's drag the leak into daylight and put numbers on it, line by line, straight off your statements. Start with ACH. Standard outbound ACH feels free, but the delay is the toll. Your bank batches at fixed cutoffs, sends files, then waits for settlement and returns. During that gap, your app says processing, while Treasury sweeps those dollars into reserves or short paper overnight. That interest lands on their ledger, not yours. Friday 4:10 p.m. transfer, you just gifted 2 nights of float. Do that weekly and it's a quiet tax you never voted for. Next, Card FX, the spread factory. The worst trap is dynamic currency conversion. The terminal abroad asks, convert to dollars? It feels polite. It's a rake. You're shoved off the network's wholesale rate onto the merchant processor's custom rate, often 3% to 7% worse. Even if you choose local currency, many issuers tack on a foreign transaction fee. Then come weekend buffers. FX markets and CLS close. Issuers can't hedge cleanly, so they pad authorizations. Monday, they true up. If the move went against you, you subsidized their caution. Practical rules that save real money. Always pay in local currency. Decline DCC every time. Use a true zero FX card that passes the network rate and charges %. Avoid big weekend authorizations. Prepay midweek, midday local time. ATMs stack tolls too. You see the $3 of network fee. Behind the scenes, the operator, your bank, and a sponsor bank split that surcharge. Abroad, some machines force DCC unless you dig for withdraw in euros, pesos. 2 taps, 2 tolls. Fix. Map partner ATMs in your app, pull larger amounts less often, and force local currency. Wires look fast, but correspondents clip time and price. A USD wire to Europe may show sent instantly, but it hops Nostro accounts, lands received at the beneficiary's bank, then waits for their posting window. Every hop can lift a micro spread, a fee, and a daylight overdraft price. Tactics. Use OUR, charges so you cover fees up front and avoid back-end dings. Ask for an execution window, not just same day. If they can't quote a spread cap on FX, you're signing a blank check. Now the mortgage, friction hiding in the payment schedule. Escrow holds your tax and insurance for months. In many states, you earn nothing. The servicer earns on float or reduces funding needs. Amortization front loads interest. Month 1 through year 5, your payment is mostly interest by design. 2 cheap levers cut bleed. Bi-weekly payments. 26 half payments equal 1 extra full payment a year. Principal-only curtailments. Mark the memo principal only so it doesn't land in suspense. Posted versus available is the daily erosion you feel. Checks, refunds, and even payroll can sit in a provisional state. Fraud screens, sanctions filters, and settlement windows are real, but they're also adjustable. You can move availability with timing and rails. Land deposits before your bank's internal cutoff. Ask for the real times. Use instant rails, RTP, faster payments, instant SEPA where limits fit. Split large deposits across days to stay below manual review triggers. Quarter end and holidays make it worse. Treasury desks smooth liquidity ratios so discretionary outflows slow. You'll see maintenance windows and longer than usual holds. Best practice. Schedule large moves Tuesday through Thursday mornings, far from holidays and the last 2 business days of a quarter. FX nuance most people miss. No FX fee isn't the same as no spread. Issuers hedge in bulk and set internal rates. Compare your posted exchange to the network's published rate. Note the delta. If it's wide, escalate and ask for the applied spread. Premium cards sometimes credit goodwill if you show numbers. 2 quick micro stories. Lisbon ATM. 2 travelers, same machine, same minute. One declines DCC, pays in euros on a 0 FX card. The other accepts guaranteed dollars. Receipts show a 6% difference. That's a burger, a taxi, and a coffee gone. Freelancer ACH, $4,000 sent Friday 5:12 p.m. App says arrives Monday. Treasury swept his balance Friday and Sunday. Funds were tradable at 3:40 p.m. Monday. The market moved 1.1% in between. He ate opportunity cost. Now he uses instant push midweek or ACH Thursday morning. Okay, build a 30-day audit. Track. Outbound transfer timestamps versus availability. Tag float days. Card FX save receipts. Compare to Visa/MasterCard daily rate. Log slippage. ATM surcharges and any forced DCC. Mortgage statement. Interest versus principal. Escrow interest policy. Refund and payroll posting times, especially over weekends. Add one more, the interest delta. Compare your average idle cash yield to a safe top-tier benchmark, T-bills or a solid sweep. If you're at 0.4% while bills sit above 5%, the gap is your biggest drain. Move idle cash this week. Fast fixes you can finish today. Kill DCC in your habits, say charge in local currency. Switch to a true 0 FX card. Retire the percent with shadow spread plastic. Push time-sensitive money over instant rails. Raise your app limits now. Hit morning cutoffs. Ask support for the actual times, not marketing fluff. Consolidate idle cash into an insured sweep or T-bill ladder. For mortgages, bi-weekly plus, principal-only notes. Ask about re-amortization after a lump sum. Once you total fees, spreads, float days, and the interest delta, you'll see your monthly leak in black and white. That's not a theory. That's your cash walking out the door in cutoffs and cushions. And now you know where to shut the valves. Debt Alchemy, how unit drift multiplies what you owe. Okay, so here's the twist you feel but can't name. When the unit drifts at the top, your debt math amplifies it at the bottom. Not just higher prices, timing, buckets, and cycle rules turn small delays into compounding. Start with amortization because that's the quiet engine. Loans calculate interest on the outstanding principal each day or month, then take their cut first. Early on, your balance is big, so most of your payment is interest by design. Miss the cutoff by a day, more of the period accrues at the higher balance before any principal reduction hits. Same rate, worse outcome, because time moved against you. Now this is important because schedules favor the lender's liquidity. They want front-loaded certainty. You carry the option risk. 2 cheap levers flip it. 1. Bi-weekly payments. 26 half payments equal 1 extra full payment a year, pulling principal forward where interest is thickest. 2. Principal curtailments. Mark principal only, so extra dollars don't sit in suspense or prepay the cheapest bucket. Cards are the purest time trap. Grace only applies if you pay the entire statement balance by the due date. Pay $1 short or 1 day late and you lose grace on new purchases. Average daily balance rules mean timing rules you. A big charge right after the statement cut rides almost a full cycle before you pay. A big charge the day before gets paid fast. 2 identical carts, different interest because of a timestamp. Buckets make it messier. Your card can carry multiple APR buckets, promos, purchases, cash advances. Issuers often apply payments to the lowest APR first unless you direct otherwise. So a refund or a small overpayment can feed the cheap bucket while the high APRA balance keeps compounding. Fix. Target payments to the highest APR and call to reallocate if they misapplied. Many issuers grant a one-time courtesy. Now student loans, the dark art of negative amortization. Income-driven plans can cap payments below accruing interest. The unpaid interest capitalizes at plan changes or set intervals, making tomorrow's principal bigger. You're paying to stand still. Watch recertification windows, miss them, and you can snap back to the standard plan with all that accrued interest stuffed into principal at once. Set alerts 90, 60, and 30 days out. Submit early. Mortgages sneak in escrow float. Your servicer holds taxes and insurance for months. In many states, you earn nothing. They reduce funding need or earn on the balance. Amortization is already front-loaded. Escrow adds time on top. If you can, choose interest-bearing escrow or lower required cushions. Better, recast after a lump sum principal payment. Many servicers will re-amortize, tiny fee, lower monthly, same rate, so less interest piles up where it hurts. Penalties weaponize time drift. One late card payment can trigger a penalty APR north of 20% that applies to existing balances at some issuers. One overdraft can cascade into multiple fees as each pending item settles. Your defense is boring and lethal. Sync cycles to cash. Move due dates to 2 days after payday, shift utilities a week later, and put minimums on auto pay with a manual top-up. You remove the single point of failure. Funds not available because a deposit hit after cutoff. Micro story: a viewer had a 4.9% promo on a balance transfer for 18 months. He set auto pay to minimum plus 50. Month 7, a $400 refund posted 2 days after statement cut. The issuer applied it to the promo bucket, not new purchases. New purchases carry 24.99% with no grace because he wasn't paying statements in full. He called, asked for reallocation, paid the purchases bucket that month, then set a second auto pay to sweep new purchases in full. Interest charges dropped the next cycle. Same cash, new order, different outcome. Buy now, pay later looks kind, but it's a float farm. The platform advances funds to merchants at a discount, then collects from you over 4 or more dates. Miss one, and they reattempt across linked funding sources, tack on late fees, and may report. Chargeback rights differ from cards, so disputes can trap funds while your schedule keeps ticking. Treat BNPL like a loan. Calendar the dates, keep a dedicated funding account, and never stack plans across pay cycles. Everything changes when you accept that statement dates are design choices. Issuers' time cuts to their funding rhythms and consumer habits. If your income hits mid-month but your biggest bills cut 3 days before, you're always one hold away from a fee. Call and move cut dates. Many will say yes in minutes. 2 moves that tame drift fast. 1. Stack payments early in the cycle. On cards, pay twice. 1 small payment right after the statement cut to shrink the average daily balance. 1 full payoff on due date to keep grace. On mortgages, add a small principal-only curtailment in month 1 of the year. It ripples through the schedule. 2. Tighten buckets. Consolidate high APRA balances onto a time-boxed promo with a payoff plan, then stop new spend on that line. Keep everyday spend on a clean card you clear monthly. Last micro story: a couple aligned all due dates to the second business day after payday, set auto pay minimums, and added a weekly 50 principal only on their mortgage. They also paid a $200 card prepayment right after statement cut. In 12 months, interest across loans dropped by 4 figures and their mortgage shaved 9 months off the tail. No new income, just time ordered. Unit drift won't stop, but once you control timing, buckets, and cycles, the alchemy runs for you, not against you. The Settlement Priority Index: who gets paid first every time. What I'm about to show you is the decoder ring. Call it the Settlement Priority Index, SPI. It's not a law on paper, it's a way to rank who clears first at what price when stress hits. Once you see your tier, every pending, every mystery spread starts making sense. Here's the ladder. SPI 1 is the apex. Central bank reserves moving on real-time gross settlement rails. Fedware target 2, chaps, between institutions with accounts at the central bank. Those payments are profunded or collateralized. Finality is immediate because the system guarantees it. SPI 2 is the utilities and primary dealers that net exposures and settle in central bank money. Think CHIPS members, CLS participants. They don't always hit instant, but they batch with daylight credit, haircuts, and strict windows. They live near finality. SPY3 is large commercial banks and processors with direct lines into those utilities. They can toggle priority flags, post collateral for faster lanes, and buy certainty with intraday liquidity. Their clients feel speed until the pipe breathes shallow. SPY4 and below, that's everyone else. Small businesses, households, freelancers, cardholders, whose balances are promises that update after the top tiers reconcile. Your right to money is real but conditional. Timing, pricing, and policy decide how real. Now this is important because you can't see SPI on a dashboard, but you can track proxies that light it up. In the United States, watch IORB, the interest on reserve balances, or SOFR, the secured overnight financing rate. Then compare it to your savings APY. When IORB sits at, say, 5+% and your savings pays 0.40%, that gap is your position in line. The wider the gap, the lower your SPI. If your bank narrows it when markets calm, they're sharing a sliver of priority. If they don't, you're funding someone else's finality. Everything changes when stress arrives. Haircuts widen. CLS tightens cutoffs. CHIPS members boost profunding. Top-tier spreads stay relatively tight because central banks backstop their pipes. Bottom tiers pay with time and price. You'll see temporary holds grow, instant rail limits shrink, weekend FX buffers fatten, retail translations of wholesale caution. Micro story, a payroll shop ran bi-weekly batches via ACH. During a rate spike, their bank quietly added next-day reviews on files over $100,000. $2 cycles hit pending. Morale cratered. Treasury revealed RTP limits, $25,000 per item, $250,000 daily with profunding. They split payroll into 10 RTP pushes. Funds landed in seconds. Same dollars, higher SPI rail, problem solved. So how do you use SPI without a badge? 2 verbs, watch and root. Watch these monthly. Priority gap, IORB or SOFR minus what you earn on idle cash. Retail spread, best in market high yield savings versus your bank's APY. Instant limits, per item and daily caps in your apps, note any sudden trims. Weekend FX pad, your card's posted exchange versus the network's rate. When the priority gap widens and your APY doesn't budge for 30 days, move idle cash to higher SPI venues. Insured sweeps that auto-spread deposits, or a T-bill ladder at a brokerage that credits interest daily. If you want same-day liquidity, many brokerages let you sell and settle T+1 while leaving a cash buffer for transfers. Route payments to rails with posted collateral and strict finality. For payouts that matter, rent splits, vendor bills, refunds, prefer RTP, faster payments, or instant SEPA. If your provider throttles during stress, split into smaller tranches inside instant limits. You're not gaming, you're matching your flow to the windows that still move. Cross-border, demand an execution window and a guaranteed spread. If they won't quote, assume you're donating float. For high-value corridors, use providers inside CLS for the FX leg, or pre-convert midweek when markets are open and CLS is clearing. Avoid big Friday night authorizations overseas. Prepay at the desk in local currency on a true zero FX card. Here's a quick rule that saves real cash. When SOFR rises and your APY lags a full cycle, call retention with numbers. Benchmark is X you're paying, Y narrow, the gap, or I transfer. If they value your deposits, they'll bump. If not, they've told you your SPI, move. Pre-position before storms. Raise your instant rail limits now. Open a lightweight backup account on a different rail. Keep a small buffer at a brokerage sweep you can pull instantly. Test 2 exit drills, 1 instant push, 1 next day ACH. Log timestamps. In stress, you won't improvise, you'll execute. Final micro story. A nonprofit faced quarter-end throttles from its bank. Grants landed Friday. Vendors needed paying. They moved recurring payouts to midweek RTP, parked idle cash in a sweep pegged near SOFR, and kept a T-bill ladder rolling. Their priority gap shrank by 3 percentage points, and pending stopped wrecking Fridays. SPI is a queue, not a conspiracy. Insiders clear first to keep the pipes alive. Your edge is knowing the lineup, watching the proxies, and routing yourself closer to the rope before the room gets loud. Playbook, how to reduce the drain without going off-grid. Okay, so here's the thing. You don't need to blow up your bank. You need to move like the rails move, fast where it's final, careful where it's sticky, and always inside the cutoffs. Step 1, turn on instant rails. Ask your bank, do you support RTP or instant SEPA or faster payments? If yes, enable it, raise per item and daily limits and set alerts on every instant hit. If no, open a lightweight secondary account that does and bridge through it. Then route time critical cash, payroll splits, rent shares, vendor payouts over instant. You're buying Finality with profunded liquidity. Worth it. Step 2, collapse the priority gap on idle cash. Park checking level cash only where you need it. Sweep the rest to a high-yield insured sweep account or a T-bill ladder. Set a weekly auto transfer from checking to the sweep. If your bank pays 0.40% while bills sit above 5%, you're gifting the spread. Don't. Brokerages that credit interest daily make your pending buffer earn while it waits. Step 3, murder DCC and tame FX. Abroad, always pay in local currency and use a true zero FX card that passes network rates. Avoid big weekend authorizations. Prepay midweek, midday local time. For cross-border wires, demand an execution window and a guaranteed spread. If they won't quote, assume a blank check and use a provider that shows live rates with a fixed markup. Step 4, hit the real cutoffs. Every bank has internal posting windows that don't show in the app. Call and ask, what's the last inbound time for same-day availability? What's the outbound instant window on Fridays? Land deposits before that, push payouts right after. Tuesday to Thursday mornings beat Fridays and month ends every time. Step 5, feed the code. If you invoice, add ISO 20022 style data in the memo fields, invoice IDs, purpose codes, tax numbers. Rich data lowers false positives on compliance screens and clears holds faster. For recurring large receipts, ask for higher immediate availability thresholds after 90 clean days. Many banks approve with a form and history. Step 6, split to dodge manual review. If items above $10,000 trip next day checks, send 4 $2,500 instant pushes inside your limit instead of one OC that sleeps all weekend. Same dollars, different lane, no hold. Step 7, sync your life to your cash. Move card statement cuts to 2 days after payday, push utilities 1 week later. Put minimums on auto pay, then add a manual top-up to full. You'll keep grace, kill late fees, and neuter funds not available because a deposit hit after cutoff. Step 8, recast amortization. On mortgages, go bi-weekly. 26 half payments equals 1 extra full payment a year. Add small principal-only curtailments early in the year. Ask your servicer about re-amortization after a lump sum. Tiny admin fee, lower monthly, same rate. Interest drops right where it's thickest. Step 9, price transparency with processors. If you run a business, negotiate interchange plus instead of blended card rates, set Sunday cutoffs for client payments, and offer small early pay discounts. 1/10 net 30 pulls cash to instant rails and cuts float days. Add RTP details on invoices so payers can hit Finality now. Step 10, build a pending buffer. Keep 1 week of expenses in a high-yield sweep you can pull instantly. When longer than usual holds show up, you won't swipe a penalty APR to bridge 2 days. Travel drill, map partner ATMs in your app, disable cash advances, pre-notify travel, force local currency at the terminal, pull larger amounts less often. Keep a backup zero FX card in a separate bag. If a hotel insists on a weekend hold, prepay midweek at the desk and keep the receipt. Negotiation script you can use tomorrow, call retention. SOFR is X, your APY is Y, narrow the gap, or I move balances today. If they budge, great. If not, transfer and set a calendar reminder to recheck in 30 days. Numbers beat vibes. Optional advanced move only if you're compliant. A regulated stablecoin bridge for weekends. On-ramp and off-ramp with licensed providers, whitelist addresses, enable withdrawal holds, convert fast, and keep balances minimal. You're renting 24/7 settlement for the gap hours, nothing more. 2 micro stories. A nonprofit moved grant payouts to midweek RTP, kept reserves in a sweep pegged near SOFR, and tested a $5,000 Friday instant pull, cleared in seconds. Their pending drama vanished. A freelancer shifted all client invoices to include purpose codes and invoice IDs, asked the bank for a $7,500 immediate availability cap after 3 clean months, and moved big transfers to Wednesday mornings. Holds dropped from 2 days to hours. Last, run your monthly personal erosion rate. Track fees, FX slippage, float loss, interest delta, and your personal inflation gap. If PER rises, cut the biggest line first, the interest delta with a sweep or T-bills, then kill DCC, move timing, and raise instant limits. Do that and you're not outsmarting the system, you're finally playing on its clock. False ending 1. The coming flip gold CBDCs are both. Brace yourself because the plot thickens. Central banks have been adding gold since the 200 ones, not for romance, for insurance. After reserves were frozen in 2022, every policymaker asked the same question. When your counterparty questions your law, what still clears? Gold does. Metal under your flag can't be sanctioned as easily as securities sitting abroad. At the same time, they're building CBDCs, central bank digital currencies, promising instant programmable settlement. Put those together and the signal is loud. Certainty at the top, software rules at the edge. You probably think great instant money for everyone. Maybe, but follow the incentives. Today's spread lives in delays, ambiguity, and float. CBDCs kill float by design. If a retail CBDC lets you pay a merchant in final central bank money in a second, who loses? Issuers, acquirers, processors who live on interchange and processing windows. That margin won't vanish. It'll get recoded as visible tiers. Free slow lane, priced priority, corridor surcharges. Programmable money is policy with a GUI. Now this is important because programmability changes your friction. Right now, a weekend FX pad is a cushion. In CBDC land, the rule can be explicit. Friday 6 p.m. to Monday 8 a.m., cross-border payments clear only on a premium channel with posted collateral, capped size, and known tariffs. No mystery holds, but a posted price for certainty. Same hierarchy, clearer signage. Everything changes if gold sits under the wholesale layer. Picture this: central banks settle wholesale CBDC against reserves partly collateralized by gold baskets. Retail taps wallets run by supervised intermediaries. The apex gains trust, the base gains speed, within rules. Gold isn't your redemption right, it's their bargaining chip for swap lines and emergency backstops. If stress hits, haircuts widen up top and the retail layer sees throttles. Lower limits, shorter windows, higher priority fees. The 1928 move, convertibility for the few, elasticity for the many, goes digital. Fragmentation pushes this further. Parallel rails, CIPS, SBFS, local RTGS bridges are growing. If blocks settle trade on non-dollar CBDC corridors with gold as trust glue, SBI values fork. Inside the block, instant and cheap. Across blocks, slower, pricier with embedded compliance. Your weekend FX pad becomes a corridor parameter. Certain routes run T plus now at a price. Others run T plus next no matter what your app says. Not punishment protocol. You might ask, do banks just vanish? No, their role shifts. If the central bank runs the base ledger, commercial banks compete on overlays, credit lines, identity assurance, fraud guarantees, working capital analytics. The float they lose, they try to earn back as explicit services. Today's hidden rake becomes posted fees, guaranteed settlement windows, insured reversals, priority corridors. Some of you will pay for T plus with protection. Others will take T plus 1 to save. Here's a micro story from a pilot. A merchant payout split on the fly, net to wallet in seconds, tax remitted instantly to treasury with a rule-blocking payout above a daily threshold without posted collateral. No float, no, we'll remit later. Clean for the state, tidy for the rail, jarring for anyone used to riding the gray. Consumer protections can improve or get prescriptive. A programmable wallet can enforce cooling of periods, auto-decline DCC, cap overdrafts, and force point of consent FX with transparent spreads. It can also geofence transactions, throttle cash-outs during stress, and rank payments by policy. Grid-critical clears, discretionary weights. If energy volatility spikes or collateral haircuts widen, a CBDC can slow large outflows at the edge to protect wholesale finality. System stability first, again. So what does this mean for you right now? 3 moves. 1. Get closer to finality with providers already pledging instant rails and transparent FX. They'll be first to plug into CBDC corridors. 2. Expect pricing to flip from hidden to posted. Read the tariff, pick your lane, and stop hoping for fast. 3. Pre-position across rails, bank, credit union, brokerage, sweep, so throttles on one wallet don't choke your month. Wait until you see the catch, though. Resets don't hand you control, they make the control easier to see. Gold will shore up trust where law is shaky. CBDCs will hard code who gets speed at what price under what conditions. The float won't die, it'll wear a badge and a menu. And if history holds, the cleanest rules will arrive with a rewrite of who eats the cost when stress hits. False ending 2. Resets are debt rewrites, not mercy. Are you sitting down? Because resets don't heal the wound, they move it. Look back at the 1930s. Countries devalued to kill deflation and breathe. Exporters cheered, sovereigns got relief, and savers woke up poorer. If your cash sat in the bank, its buying power shrank overnight. Bondholders were made whole in lighter units. The priority held, keep the pipes alive, bill households later. Most people think the 1970s freed the world when the dollar left gold. Trust me, you're not ready. The peg died, but volatility moved in. Oil shocks, rate whiplash, spreads that suddenly meant something. Banks learned to price that chop into everything. Wider FX margins, fatter cushions, variable rates that jumped without warning. Freedom at the top came with a volatility tax at the bottom. Fast forward, emerging market breaks in the 1990s. Mexico, Asia, Russia ran the same playbook. Controls, emergency hikes, forced conversions, deposit gates. Cyprus in 2013 gave the modern template, bail-ins. Instead of taxpayers propping up banks, large depositors took haircuts to recap them. The rails kept running. Stability returned on paper. The cut lived in customer balances. Now this is important because today's resolution rulebook quietly encodes the choice. Single point of entry. Minimum requirement for own funds and eligible liabilities. MREL and TLAC. These sound like seminar slides. They're tools to impose losses on shareholders and certain bondholders first. Good. But deposits above insured limits sit in the zone that can be gated, delayed, or haircut if necessary. Payment finality for insiders stays sacred. Retail availability becomes elastic by law. Everything changes when you reread your agreements with this in mind. We may delay availability in certain cases. Funds deposited after cutoff are considered received the next business day. Right of set off. These aren't decorations. They're the retail echo of wholesale netting and loss allocation. In a reset, those clauses root pain around institutional finality and into your schedule, your rate, your access. Micro story, 1998 Seoul. An exporter borrowed in dollars because the rate was sweet until the one snapped. The central bank defended, then floated. Swap lines kept big counterparties breathing. He called his bank to roll the loan, margin doubled, grace vanished. He sold inventory at a loss to meet calls. The bank lived. He survived, smaller. Debt rewrite, not mercy. Another one, Cyprus, 2013. A small manufacturer held 600,000 euros for payroll and suppliers. The weekend arrived, banks shut, capital controls landed. Insured deposits under 100,000 euros reopened slowly. Above that, balances froze and later converted into bank equity at a discount. He paid 10 workers with family cash, begged suppliers for time. When funds dripped out, FX and trust had both moved against him. The system stabilized. His balance sheet paid. You probably think deposit insurance protects you. Up to the limit, it does. But time is the hidden blade. Claims take days if a bank actually fails. Interest without formal failure, holds can stretch under liquidity management. Bills don't pause for processing. That gap becomes a haircut paid in late fees, emergency credit, and lost discounts. So what do you do, practically? 3 moves you can finish this week. 1. Diversify custody, not just assets. Keep operating cash at 2 institutions on different rails, one with robust instant payment limits, the other with a strong sweep into T-bills. Test both with live dollars. Send $1,000 on a Friday morning and log timestamps. If one jams, you've learned cheaply. 2. Pre-read your exits. Download account terms and search 3 strings. Availability, set off, finality. Then call and ask, what is the last inbound cutoff for same-day availability? What are weekend instant limits? What triggers case-by-case holds? Write it down. Move big inflows to land before their real window. Split payouts to stay under manual review thresholds. 3. Ladder your obligations. Stagger due dates so one bank's hiccup can't domino your whole month. Put minimums on auto pay. Add a tiny pending buffer at a brokerage sweep you can pull instantly. If a reset day shows up in miniature, hold stretch, limits tighten, you bridge with cash, not penalty APR. Bail-ins versus bailouts is a false fork. Both keep the rails intact. The only questions are who pays and when. In bailouts, taxpayers and future inflation shoulder the load. In bail-ins, large creditors and some depositors eat principal today. In both, retail time absorbs uncertainty. That's why your best defense isn't outrage, it's prepositioning. You can't sprint to safety during a reset. You move before. Micro checklist to lock this in. Open a backup account with instant rail support. Verify per item and daily limits today. Set a brokerage sweep or T-bill ladder for idle cash. Move the first chunk now. Shift your card statement cuts to 2 days after payday. Push utilities 1 week later. Run 2 practice exit drills. One instant push, one next day ACH. Log the delays. Park 1 week of expenses in a high-yield sweep as a pending buffer. Plain lesson, no spin. In every reset, priority holders survive. Retail funds the stability through time, through price, or through principle. It was true in the 1930s, the 1970s, the 1990s, 2013, and the mini-panics since. The names change. The structure doesn't. Once you accept that, resets stop feeling like thunderbolts and start reading like scheduled maintenance, with a surcharge. The clause that survived: payment finality and right of set-off. What I'm about to show you sits in plain sight, but it's the switch that keeps your balance on a leash. Two phrases run the show: payment finality and right of set-off. Once you see how they work together, the gap between posted and available stops being a mystery and starts looking like a lever. Start at the top with payment finality. In wholesale rails, Fedwire chaps target 2. Once a transfer settles between participant banks, it's irrevocable. That's the sacred promise. Participants can't claw it back. But here's the catch. Finality at the rail is not the same as availability in your account. Your deposit contract says the bank credits you when it's satisfied with risk screens, returns windows, and cutoffs. So the system can be final upstairs while your app still says pending. That's design, not a glitch. Now this is important because your account terms mirror that split. Pull up a fund's availability policy and you'll see phrases like case-by-case holds, longer delays in certain cases. Deposits after cutoff are considered received the next business day. Those lines exist so the bank can wait out returns risk on checks, compliance flags on wires, and fraud analytics on card credits. Wholesale finality lets banks sleep. Availability policy lets them decide when you sleep. Pair that with the right of set-off and the hierarchy snaps into focus. Set-off lets your bank take money from your deposit to cover debts you owe them, credit card, overdraft, small business line, without asking, sometimes without notice. If a deposit lands while you're behind on their card, they can net it before you ever see available. It's not theft, it's netting claims under one roof. But for you, it means their balance sheet takes priority over your timing. Close-out netting extends the logic between institutions. Banks sign master agreements that collapse mutual exposures into one net number if a party fails. That keeps the rails clean. But again, the certainty lives at the top. Your ledger below updates after upstream netting, fraud checks, and policy gates. Apps love green checks. Contracts love qualifiers like provisional credit may be reversed if the item is returned unpaid. Read that again. Provisional means conditional. Let me ground this with a quick story. A freelancer deposits a $9,800 check from a new client on Thursday at 3:58 p.m. Internal cutoff is 3:30 p.m. The app shows posted. Overnight, the bank's risk engine flags the routing number cluster as high return risk. Funds availability policy flips to case-by-case hold for 5 business days. Friday, her credit card auto-pay to the same bank hits. Right of set-off sweeps the few dollars that were instantly available, and a late fee lands on the card for the balance. She calls furious. Support quotes the contract. After cutoff deposits, case-by-case holds, set-off rights. No villain, just rules firing in order. Holiday and quarter end add teeth. Policies say deposits on non-business days count next business day. Force majeure lets banks extend delays for outages or market closures. So a Saturday card refund can show posted but won't be available until Monday or Tuesday if screens kick it. If CLS is closed and FX markets are shut, weekend foreign authorizations book with buffers. Monday, you get trued up. If the move went against you, you wore the cushion. You probably think, okay, that's grim. What can I do? 3 fast levers. 1. Choose institutions with first dollar availability and short hold tables. Many credit unions and some online banks post clear matrices. Same-day availability up to a cap, larger sums partial today, rest tomorrow. 2. Separate your debt from your deposits. If your checking and your card live under one roof, set-off bites harder. Park your emergency buffer at a different bank so one shop can't net your life. 3. Deposit with timing and data. Land funds before real cutoffs. Feed rich remittance info, invoice IDs, payer details, so ISO 20022 screens green light you faster. Wires versus ACH matters too. Incoming domestic wires usually sit closer to immediate availability because returns are rare and settlement is firm. ACH credits can be held longer due to return windows. If a payer reliably wires you, favor that route. If it's ACH, break large payments into smaller, earlier credits so you don't trip manual review near cutoff. Labeling helps. For extra loan payments, write principal only so funds don't drift into interest or suspense. For big deposits tied to invoices, put invoice numbers in the memo. More context equals fewer manual reviews. And yes, you can negotiate. After 90 days of clean history, ask for higher immediate availability caps on recurring payers. Business customers get this all the time. Retail rarely asks. Bring statements and be specific. Average ticket size, payer list, 0 returns. Final micro story. A small clinic switched processors. First week payouts hit Friday at 4:12 p.m., 12 minutes after cutoff. App showed posted. Landlord's pull Saturday failed. Monday, 2 fees, the landlord's return fee and the bank's overdraft. They moved payouts to Wednesday mornings, submitted a limit increase request with 90 days of clean receipts, and linked rent to a high-yield sweep with instant pull. Next month, the same payout cleared same day. Rent hit clean, no fees. Same money, new order. So that's the clause that survived the 1920s logic. Payment finality secures the apex. Funds availability and set-off manage the base. Gold for the few became certainty for the few. Elasticity for the many became pending for you. Once you read your terms with that lens, you stop expecting magic, and you start moving inside the rules that actually run your Tuesday. Your erosion rate, a simple personal index. Look, I'm gonna tell you something. If you don't measure the leak, you'll keep funding it. So we're building one number you can run in an hour that tells you exactly how hard the system is skimming you. Call it personal erosion rate. It's simple, fast, and ruthless. Total annualized drain divided by your annual income as a percent. Once you see it, you'll know where to cut first. Here, what actually goes in the drain bucket. 5 parts, no fluff. First, fees you actually paid. Overdrafts, ATM surcharges, wire fees, card late fees, account maintenance, expedited transfer charges, even paper statement fees. Don't argue with names. If money left your account for a bank rule, it counts. Export statements for the last 30 days, tag every line, total it. Second, FX slippage. Any foreign card charge or cash withdrawal where you didn't get the card network's posted rate is leakage. Pull the Visa or MasterCard daily rate for your transaction date. Compare to what posted, multiply by the amount. If a €300 dinner should have landed at 1.091 and you got 1.057, you lost about $9.60. Add them all. Third, float loss. This is the time tax on pending. Use a simple proxy, daily risk-free rate times dollars held times days delayed. Take a benchmark like a solid treasury money market fund or the interest on reserve balances. If it's roughly 5% annually, daily is about %. So a $2,500 payroll held 2 days costs you about 69 cents. Small once, huge across a year. Fourth, the interest delta on idle cash. This is the big one. Find your average balance in low-yield accounts this month. Multiply by the spread between a safe top-tier yield, T-bills, a strong insured sweep, and your current APY. If you held $14,000 at 0.40% while you could have earned 5.1%, the annual delta is about $658. Monthly slice is that divided by 12. This line alone often beats all fees combined. Fifth, your personal inflation gap. Not the headline number, your basket. Pull 6 months of spend in your top 5 categories: rent or mortgage, groceries, transport, utilities, healthcare. Compute your own year-over-year change. If essentials rose 5.4% and your income rose 3.1%, that 2.3% gap applies to the essentials share of your income, not the whole. Multiply the gap by that spend slice. Annualize. Now add those 5. That's your annualized drain. Divide by your annual income, net or gross, but be consistent month to month. Multiply by 100. That percent is your per. Let me show you a clean micro example. Maya earns $92,000. In 30 days, she logs. Fees, $38. $1 ATM, 1 wire, 1 rush transfer. FX slippage, $14 from a weekend hotel hold and a sneaky terminal conversion she missed. Float loss, $1.21 across a few pending deposits. Interest delta. Average idle $11,800 at 0.40% versus 5.1%, approximately $553 annual. Monthly slice approximately $46.08. Personal inflation gap. Essentials up 4.1%. Her raise 2.2%, right arrow 1.9% gap on $2,650 essentials. Spend equals about $50.35 monthly. Annualized $604.20. Annualized totals. Fees, FX, float $15, interest delta $553, inflation gap equals $1,796. Per $1,796, $92,000 approximately 1.95%. Quiet number, loud message. Everything changes when you turn PER into a dashboard next to two live proxies. Priority gap, benchmark like SOFR or the interest on reserve balances minus your savings APY. If it widens and your bank doesn't move within 30 days, you're funding their cushion. Shift cash. Retail spread, best in market high yield savings minus your bank's APY. If you're 300 basis points behind, stop arguing and transfer. Now fix PER in order of impact. First, collapse the interest delta. Sweep idle cash weekly into a high-yield insured sweep or a T-bill ladder. If you need same-day liquidity, keep 1 week expenses in a sweep that credits daily. Second, kill FX slippage. Always pay in local currency, avoid big weekend authorizations, and use a true zero FX card that passes network rates. Third, shave float loss. Land deposits before real cutoffs, prefer instant rails for time-critical flows, split big items under manual review triggers, and avoid Fridays and quarter ends. Fourth, nuke nuisance fees. Move due dates to 2 days after payday, put minimums on auto pay, set alerts at 80% utilization, and ask for one-time reversals today with receipts. Fifth, compress the inflation gap you control. Lock in annual discounts only if the discount beats your opportunity cost. Otherwise, go monthly and churn. Reshop insurance and mobile plans. Many of you can cut 10 to 20% in an hour. Run PER monthly. If it rises, you drifted down the queue. If it falls, you're walking toward the rope. Once you can see your personal erosion rate in dollars and days, every pending and spread turns into a lever you can pull. If this helped, subscribe and turn on alerts, then watch the next video where I map the fastest cash routes most people can switch to in one afternoon. RTP plays, cutoffs, and zero FX picks. Drop your PER in the comments. I'll live audit the sharpest cuts.